Thanks for tuning into Alpha Moguls, a show where we speak to some of the finest investing minds about their portfolio creation strategy for creating alpha over the next 12 to 24 months. Our guest today is Hiren Ved of Alchemy. Hiren, pleasure having you. Thanks for taking the time out.
Thanks, Niraj. Always a pleasure to be on your show.
Thank you. Hiren, I reckon the rising tide carries all boats, but the last 6 to 12 odd months, have they been difficult to generate alpha, or has it been possible because the broader end of the spectrum has rallied even more than what the indices would have?
So, Niraj, I think, the cycles that we've seen in the markets is that whenever there is either a domestic or a global macro headwind, the market tends to become narrow, right? And when there are tailwinds or some of those headwinds tend to recede, you tend to see improvement in the breadth of the market. And that is what we are seeing, especially, I would say more than, instead of 6 months, I would say in the last 4 months, since April onwards, we have seen a significant improvement in the breadth of the market. The number of sectors and stocks that are hitting 52-week highs is of a very different order. And that tells you that the quality of this rally is far superior than the quality of many rallies that we see where the markets tend to be very, very narrow, right? And a lot of that has to do with the fact that 2 or 3 things. One is that last year we had significant headwinds on margins, and there was negative operating leverage for a lot of companies, especially non-BFSI companies. And you had rising interest rates, and therefore you had a compression of P multiples in high growth stocks, right? So you had a double whammy. You had a margin compression and you had an impact on P multiples because of rising rates. This year, you have the exact opposite. You have falling commodity prices and margins are coming back, and rates, one could argue that there may be another rate hike or 2, but by and large, we are towards the end of the cycle rather than the beginning of the cycle. Last year, we were just starting the rate hike cycle. This year, we are almost towards the end of the rate hike cycle. And therefore, you see a dramatic change in the way the markets have responded, right? And therefore, I think that if that continues to be the construct where margins will improve and rates seem to be toppish, the breadth of the market will be reasonably strong.
Okay. Hiren, I'm just trying to think tactically in the portfolio. One, I mean, where are you fully invested currently? Part 1. Part 2, there are people who are saying that with the recent Fed commentary or the big 4 central banks commentary, if there's a bit of a liquidity withdrawal, then we might see a bit of a corrective move as well. I'm trying to think tactically, are you preparing for something like that in the second half to maybe take advantage later on? Or are you convinced about the long term so much that you're not making wholesale changes to the portfolio?
So, Niraj, I'll tell you, first of all, we are completely convinced that we are in a long-term structural bull market in India. After a long time, a lot of things are falling into place, right? That does not mean that in any long-term bull market, you may not have phases where there are corrections or sideways movements in the market. However, having played a couple of bull markets in the past, the lessons is that do not try to optimize within a bull market. If you are convinced on the big picture, right, you may make a few tactical shifts between sectors here and there. All that is fine. It really depends on each investor or portfolio manager's philosophy. But one big learning is that you do not try to optimize by saying that, okay, there could potentially be a correction because of withdrawal of liquidity, and therefore let me keep some cash and then I will reinvest it later on. And the risk with that is no different than, let's say, 6 or 8 months ago, when there was a big expectation that the US economy will go into a recession, right? And everybody was talking about it. The fact of the matter is that the US hasn't gone into a recession. And the problem, therefore, in terms of making these macro level forecasts, is that you don't know whether you will be right or wrong, no matter how strongly everybody believed that that would be the scenario, right? So I do not want to change anything or my positioning in the portfolio based on some hypothetical event that may or may not occur in the future, right? I think it's important that at the very baseline level, we believe that we are in a good market cycle. We are in a good economy cycle. There will be challenges and headwinds in between. There will be events in between, which could be elections next year, which could be, you could still have a slowdown in the second half. The cumulative impact of all the rate rises might come a little later. We don't know. But I think one thing is very clear from our perspective is that this is a bull market. Don't get off the horse. Stay on the horse.
Okay. Point well taken, Hiren. In which case, let me ask that is your portfolio currently your portfolio materially different from what an average portfolio construct would be, in that a bit of financials, maybe less IT or no IT, exposure to some of the B2G sectors, etc. That seems to be the common consensus currently. Are you different there? How are you? What is your thought when you're building out or when you're living out the portfolio construct that you have in place currently?
So Niraj, if you remember, I think we interviewed with you last year, and or maybe even before that. And for a reasonable period of time, our view has been that we were very bullish on manufacturing as a sector, right? My view is that we are going to see the kind of sector leadership that we saw during the 2003 or 2002-3 to 2008-9 bull market, which is industrials, capital goods, auto ancillary, power, real estate. Now you can throw in renewable energy, electronic manufacturing services, defense, because every cycle has a couple of new leaders, hotels, hospitals, right? Pretty much very similar to the cycle that we saw from 2003 to 2007 will broadly repeat in terms of the sector leadership that will outperform, right? Now, having said that, I think we clearly, based on that conviction, we clearly, not today, but over the last 12 to 18 months, we have been infusing manufacturing companies, capital goods companies, and we believe that these are the investments or themes that will run for a fairly long period of time, right? And therefore, we have a balance. You mentioned, so yes, we have the big banks and financials. We have a lot of stuff in that manufacturing bucket across many of these sectors that I mentioned. And we do have tech, IT investments also. Now, IT has gone through, obviously, a cycle where we are seeing that there are a few headwinds in the IT services sector. But largely, as you know, Niraj, that we have, our exposure is not to the big cap IT services sector, but largely to the ER&D companies. And you've had people like Kishore of KPIT on your show several times, and you can see the difference, right? And this quarter was most instructive in that sense. None of the companies were able to deliver a 7-8% Q on Q growth. KPIT stood out. So we have to ask a question why that, given the environment that we are seeing, some companies are able to grow much faster. And that was our theme for a long time. When we saw the ER&D companies structurally growing faster than IT services. So I think that we continue to stay with that theme because we do believe it's a long-term theme. Yes, there was a phase post-COVID when even they grew faster, and now maybe there is a little bit of a moderation, but structurally they are still growing faster than IT services, right? So I think that's how we are positioned, if you ask me. And then finally, the area which has been very soft is the consumption space in general, because obviously we have seen that we've had a K-shaped recovery. So consumption at the lower end is not doing that great, but consumption at the higher end has done okay and has held out. But there again, our view is that we are more invested in the discretionary consumption bucket where there is premiumization happening, because we believe that as our per capita income crosses $2,500, there is more money available to spend on premiumization across the board. So whether it is liquor companies or whether it is in apparels or so on and so forth, we continue to have exposure there because we believe that premiumization as a trend is likely to continue. And even in this consumption cycle, we have seen that it is more people at the lower end which got impacted rather than people at the higher end.
Got it. Thanks, Hiren. This answer gives me the opening for 3 different questions. Now, viewers, you remember that sometime 3 years ago or 4 years ago, maybe you don't remember, but Hiren Ved had given us a gem in terms of how to make a switch, wherein he had mentioned that if a stock is corrected quite a bit and a stock that you wanted to buy also is corrected by that equal sum, then don't think of booking a loss here, but thinking of making a switch so that you actually get the stock that you want. Hiren, I want one more idea about a mental model that you deploy. Now, I'm using an ER&D company as an example here. Viewers, this is not a recommendation in any stretch of imagination. But Hiren, what I'm trying to understand is, how do you tell yourself to be convinced about holding on to an investment in an expensive stock, wherein the narrative from the sell side is that, oh, things are looking very expensive. The whole sector might be going through a bit of a drawdown, but this is standing out. How do you deploy the mental model to stay invested or invest more in such companies?
So, Niraj, I think that it is very important to understand why you have bought something that you bought. What is the core hypothesis behind that, right? And if you see all the high growth companies of the past, one argument that I hear when you ask a lot of investors why they missed a great growth company, more often than not, it is valuations. And therefore, when we were looking at and we were studying everybody does these studies about companies which have delivered consistently, compounded at a very decent clip, 20% plus over years and years. And when you try to dissect what makes these companies tick, why is the market willing to give a higher valuation to these companies, is because there is visibility of higher above average growth. Okay, so two things here are important. Above average, so you can find out a sector average, broadly speaking. If your growth is above average and there is reasonable visibility that this growth will continue for some length of time, the markets continue to trade these companies at higher multiples, right? That is what history has taught us. And therefore, when I tend to look, or what convinces me to hold on to these companies, is that every time when I look at the numbers, or I reflect on the numbers, or I read on these companies, or I interact with these companies, I am only checking at two things. Will the growth rate continue to be higher than average? And do I have a reasonable confidence in the probability that this will continue for some length of time, right? If one can convince oneself on these two, and obviously, other things being equal, that, your return ratios are reasonable, your governance is good, you're not doing any capital misallocation during that time frame, then the market is willing to live with higher multiples. Unfortunately, there is no science what that higher multiple could be. In the heydays of HDFC Bank, 4 times price to book multiple was a high multiple. In the heydays of Bajaj Finance's growth cycle, 6 or 7 times price to book was a new norm. There was no historical context to it, right? Today, if you look at the ER&D companies, you're all at 50, 60 times multiples, right? There is no historical context, but there is one historical context, is that if there is reasonable runway for growth, and if companies are delivering reasonably high returns above capital, then I think the markets are willing to give a higher P. Now, obviously, we must also understand, since you asked this, and ask the viewers to kind of take away something from this, is that one of the downsides of investing in growth companies is that you are also susceptible to sometimes sharp drawdowns when things, because your valuation assumes that there is no error in execution, or there are no pitfalls for a couple of quarters. Exactly like you mentioned when you interviewed the CEO of Laurus Labs, right? I mean, we don't own it, but I'm just saying that it did phenomenally well. And then every growth company maybe sometimes goes through a patch where it is changing the business. There are a few headwinds. It is making investments. The numbers are not as great as you would like them to be. And you could see a disappointment on the stock price for some time before it gets back onto the growth path. So one has to be careful that while the journey from A to Z may look very, very tantalizing, because the CAGRs that you can make, or the returns you can make, are obviously above average, but the journey may not necessarily be as smooth. And that's where your conviction matters the most, right? And I think that how do you build that conviction is the most important secret sauce in it.
Yeah, I know. And I think a lot of it comes with experience. So I think people have to stay in the game and keep on playing it and refining it every single day to try and get it. But Hiren, this was lovely. Thank you for this. It was a really, really nice way you put this into perspective. I have one final question, but which is more not about a mental model, but the here and now before we wrap up this conversation, which is how are you deciding at any point of time or currently, for example, how do you allocate more to a particular manufacturing, a particular space within manufacturing versus some of the others? Because almost every company that you hear, the quantum of order flows, the book to bill ratios, the con calls from the companies are all looking very optimistic. So how are you deciding what is the first amongst the equals?
Yeah, I think the thing is that it is not easy, because many of these stocks have, I mean, their valuations do tend to capture some of these tailwinds, right? And therefore, the question is, how do you incrementally allocate money to those names? Well, I think what happens is that if you are coming, first of all, I believe that we are still at the early stages of the cycle. So optically, the valuations may look higher. Also, these companies would have delivered, some of them have delivered 100+% return, some of them 40-50%, way higher than what the markets have delivered, right? So maybe intermittently, even in these high growth companies, you may get a phase where you have a time correction till the earnings catches up. Now, again, the thing is that it's all about, as long as earnings growth keeps coming in, you will be fine even if you enter at a higher level. Maybe your returns from there on would matter more than what somebody would have made historically, right? Now, what we do is that, and we also understand this is a challenge. And therefore, currently, what we are doing is that while we continue to deploy money in some of these companies where the manufacturing sector across, whether auto ancillaries, cap goods, etc., we do start with a slightly lower weightage than what we would have done historically, right? Because if you do get a time or a price correction, that gives you the ability to add, because you're still playing for the longer term, because your view is that you are still in the early stages of this cycle. So that's one way to do it. Secondly, I also believe that there is always a hunting ground for good quality companies in sectors which are currently not doing well, right? Which, for example, in discretionary consumption, where these stocks haven't done anything great. They're still bouncing around their bottoms rather than bouncing around their tops, right? But where the risk reward is very favorable to you, because all the headwinds are priced in today. Now, people want to wait till they see the first signs of improvements in their numbers, right? But investing is all about the future. It's not about the past. And your judgment of whether most of the bad news is already in the price. And if you believe that it's not that India is going to grow and only manufacturing is going to do well, healthcare will do well and consumption will also do well. I think then how you allocate your money in the portfolio to some of those sectors which may not be in favor today, but where structurally you know that the business model is good. It's just the external environment that is tough. Once that external environment changes and consumption comes back, which eventually it will at some point in time, then these companies will start to perform. Now, the question is, are you a just-in-time investor, or are you willing to say that, okay, a part of my portfolio is in this high growth, secular growth bucket, but a part of my portfolio is also in companies which are very strong, but currently going through a tough phase. But it's already in the price because these stocks haven't done much. And nobody's chasing these companies today. Everybody is chasing the former, right? So you have to create a mix of risk reward in your portfolio where you have a combination of these secular growth stories, but you also have exposure to companies or sectors that are not doing well. Now, suddenly people are figuring out, okay, what should I do in pharma? Because, suddenly pharma is doing well. If you had asked anybody a question 3 months or 6 months ago, people wouldn't have cared about what is happening. So, and I think the definition of a bull market is that every sector participates finally. Even the laggard sector will participate. Maybe it participates right at the end, but every sector, and there is continuous sector rotation that keeps happening. That's how a bull market keeps going, right? And I think something similar like that will happen in this bull market. It's already happened.
Great. Cross fingers for all of that. Hiren, fabulous talking to you today. Thank you so much for taking the time out and giving us your thoughts.
Thank you. Thank you so much, Niraj. Pleasure.
The pleasure was ours, and viewers, thanks for tuning into this edition of Alpha Moguls.